Good afternoon, everybody. Uneducated Economist here. So I would like to thank Vincent. Vincent is one of our viewers here on the channel who sent me an article, who emailed me an article that I thought was just excellent. I'd like to share it with you guys today. There's a link for it down in the description. This has to deal with CLOs. Now, if you're not familiar with CLOs, I'm going to try and break it down for you, make it a little easier to understand. It's kind of complicated, but not really. A CLO stands for Collateralized Loan Obligation. Very similar to the collateralized debt obligations from back in 2007, 2008 that almost took out the financial system. Very similar. Now, collateralized debt obligations can have a lot of different loans that make up the security. So what it comes down to is, like, if you think about mortgage-backed securities, when you sign the bottom line on a mortgage, that mortgage is then sold off. It is packaged up with a bunch of other mortgages, put into a box, and called a mortgage-backed security. That's the collateralized debt obligations. The mortgage themselves is the collateral. A CLO, the collateralized loan obligations, are loans made to businesses. So all these loans made to businesses are packaged up, put into a box, and sold off as a security called the CLO. The people who build these CLOs, they cut them up into different tranches. So there's different levels to the CLO, and you can invest in these different levels. At the very top is the AAA rated stuff, meaning that the chances of that particular level defaulting is very low. The reward for it is also low. As you filter through the different levels, you will find higher risk and higher reward. When all these loans get paid, it goes to the top first and then filters down. So if you have a bunch of businesses that start to default inside of the CLO, the AAA rated stuff gets paid first, and then the lower levels get paid last. They may end up defaulting on that particular section, but the AAA rated stuff at the top is still good. Now, here's the thing. The collateralized loan obligations are loans made to businesses who are already at risk, meaning that they can't sell their bonds or they're having trouble, getting funding. The collateralized loan obligations is what gives these businesses the ability to take out debt, to take out loans. Even though there is a level inside of the CLO that is rated AAA, nothing inside the collateralized loan obligation security has a AAA rating. They are able to rate these CLOs with a AAA rating at the top level, at the top or upper tranche, with a AAA because the rating agencies don't determine the chances of default by a particular company. They're rating the default of all of them enough to not pay out on that upper level. Does that make sense? So the idea is that because you have all these businesses who are spread out all across the country from all different types of businesses, they're not related to each other. The chances of all these things defaulting at the same time enough to cause that upper level to not get paid is a very low possibility, at least according to the credit rating agencies. Now, here's the thing that I found interesting about it, is that back in 2007, they were calling these CDOs, the collateralized debt obligations, a very safe investment, especially the AAA rated stuff. Because at the time, a lot of these collateralized debt obligations were made up of the mortgages. And they were going off of the idea that all the mortgages across the country most likely would not see a rate of default of such magnitude that it would cause a default on that AAA rated CDO. But then it happened. Lehman Brothers, AIG, all these companies went under, or started to go under, if it wasn't for the government coming in and saving AIG, but Lehman Brothers went out because of that exposure to these CDOs. Right now, we got the collateralized loan obligations sitting at levels higher than the CDOs were back in 2007, 2008. So you see what's happening here? People who invest in these CLOs, mutual funds, hedge funds, pension funds. You think about it, pension funds were seeking out higher yield that they were not able to find inside of the government debts because of the government debts being so low, the yield that they pay. So CDOs, or the Collateralized Loan Obligation section, has given these pension funds the ability to invest in companies that typically they would not be able to invest in. Like, they wouldn't be able to buy the bond because the bond would be rated so low that they legally can't buy them. But they can buy into these CLOs because they're buying that upper level, that upper tranche of AAA. So I think about, like, what are the possibilities of all these businesses going into a default rate of such magnitude that it would drag down the CLO? That would be the question. Then on top of it, I think about, like, the Federal Reserve and all their new lending facilities to try and add support to the small businesses, or not even small business, just to businesses in general out there, to make sure that they stay in funding so that these CLOs continue to get paid. Now, whether that's their reasoning for it, that seems to be what's happening, in my opinion anyway. So I guess that would be the question for you guys. What do you think about these CLOs? And is the Federal Reserve worried about these things defaulting? And the level or the sheer size of the CLO market, could that bring down the financial systems if these things start to go into default? Because you think about it, if people are not willing to buy these CLOs, banks would have trouble lending money to businesses. If they have trouble lending to businesses, some of these businesses only exist for the simple fact that they are able to get a loan. The zombie companies. And if they're not able to get the funding that they need in order to continue to operate and pay their employees, and they go under, we start finding higher unemployment. The Federal Reserve is mandated to maintain low unemployment, maximum employment. They're mandated to do this. So are they pretty much funding or providing the liquidity lending facilities in order to keep these CLOs solvent? Does that make sense? I hope I explained that all right. Anyway, very interesting times we live in. I would love to get you guys' opinion on it. Uneducated Economist. You guys let me know.